Imagine staring at a live trading screen where losing money is mathematically impossible. It doesn't require a crystal ball or a lucky streak. It requires a mechanical process of shifting your defensive boundaries to lock in profit as a trade moves in your favor. The objective is to master the structural stop-loss trailing strategy. By dynamically following price action, we can entirely eliminate initial risk and secure those gains. Anyone can execute an entry. Executing the transition from offensive prediction to defensive management is what separates gamblers from professionals. To protect our capital, we place our stop-loss here, above the most recent structural high. A stop-loss can only move forward into profit. If you stretch that boundary backward, your planned risk of $1,000 instantly doubles to $2,000, breaking your probability. The real danger, however, isn't moving the stop backward. It's moving it forward too soon, a mistake usually driven by timeframe distortion. Look at this split screen. On the left, we have a clean, reliable downward trend mapping 30-minute candles. On the right, we'd zoomed into the exact same time window using 5-minute candles, revealing erratic, choppy microwaves. If you execute your trade on the 30-minute chart, but manage your stop-loss based on the 5-minute chart, you will end up reacting to meaningless noise. You'll tuck your stop behind a minor volatility spike, and the market will quickly chop back and trigger your exit. To keep a winning position alive, you have to stay relative to your execution time frame. Managing a 30-minute trade requires 30-minute structure. With our time frame locked in, we wait for a specific trigger condition to adjust our stop, a confirmed break of structure. A break of structure requires price action to clear old boundaries. We need a new candlestick to aggressively close beneath the previous downward wave. The moment that closure is confirmed, grab your stop-loss order and drag it down to perfectly overlap your initial entry price. The capital risk on this position is now gone. If the market suddenly reverses and hits that line, the trade will close out for $0 in profit and $0 in losses. Securing the break-even point removes the stress of capital exposure. We have successfully converted a risk-bearing liability into a free opportunity to capture upside. To scale that upside, we need to stop looking at individual candles and start looking at the market as a series of connected macro waves. In a downtrend, a valid structural wave follows a distinct pattern. The price pulls back briefly to form a lower high, gathers momentum, and then executes a fierce downward push. That new pullback high is validated once the price continues downward and breaks the previous structural low. Upon validation, drag the stop-loss down just above that confirmed lower high. By moving the boundary, we've structurally locked that floating profit into the account. This becomes an ongoing mechanical loop. Wait for the pullback, validate the new low, and trail the stop. We repeat this sequence for as long as the market keeps printing fresh structural lows. Instead of guessing how far the trend will go, we let the validated structure dictate our actions. We have built a mechanical ratcheting system that only moves in our favor. Eventually, the trade will approach its final take-profit zone. At this stage, the standard rules of structure require a recalculation based on dynamic risk-reward. This chart compares the exact math of the late-stage trade. The massive green section represents a 6.3% secured return. The tiny gray sliver is the 1.4% of remaining target. If we leave our stop way up at the last macro high, we are risking huge amounts of unrealized capital just to capture that final percentage point. The math here demands a tactical shift. We abandon the large structural waves and start trailing our stop tightly behind individual candle highs. Step by step, as each new candle forms and pushes down, we immediately move the stop right behind it. Recognizing the moment when dynamic risk outpaces the value of the trend allows you to switch to aggressive defense, preserving the vast majority of the move. No trend lasts forever. Eventually, the market structure will fail, and the price will snap back against your position with sudden, violent force. Without our trailing boundary, that massive upward spike would erase hours of floating profit, driving the trade back to zero or worse. But because our stop loss was firmly in place,
The reversal simply triggers our automated exit. We get stopped out, but we walk away with a highly profitable 4.6% gain, locked firmly into the account. We didn't predict the exact moment the market would reverse. We didn't need to. By maintaining a dynamic structural safety net, we forced a scenario where even a complete trend failure resulted in a definitive win.